Auto trading is generally there are several types of auto trading, but the most common is one where somebody sets a set of parameters into a charting or momentum or charting package, and it says when the 10-day stochastics against the 5-day moving average cross, I want to buy, or every time the multiple of the FTSE versus the DAX goes below 2.3, I want to buy, and when it goes above 2.7, I want to sell, or something like that. So you set your systems to do this, and so the systems will automatically make the trade without you having to do anything. You just set the parameters in to the computer. It says when the 5-day moving average crosses the 10-day moving average on the downside, I want to buy. When it crosses on the upside, I want to sell. And then you set that and just leave it. And you can just leave it for a year, as long as you've got the money in the account, and it'll just boom, every time that happens, it'll buy or sell. And assuming you've done all your analysis, you don't want to be sitting in front of the computer waiting for that moment in time. You might be out having a round of golf or something. So you set the computer to make the trade for you. To be honest, that kind of trading I do tend to agree with. If you've done your analysis correctly, and you've seen in the past that it works, and for some reason, and you take all emotion out of it, and don't just set the computer up, put a load of money down, set the computer up and just leave it and see what happens. Okay, after 3 months, if it's losing all your money, then you stop. But you never put your own emotion into it, and because that's what kills traders, is emotion.
Yeah, well, that's funny because you probably agree with this statement that the real winners today are people who are using the software algorithms to manage their trading.
Software algorithms are successful for a very small number of people. Algo traders aren't actually systems. They are people who trade very, very, very fast indeed, and they are takers of liquidity on the foreign. In general, they're in the foreign exchange markets or in the futures markets, the high liquidity futures markets. And what they are is the computer suddenly sees the dollar yen's moved, the yen Canadians had a buyer, blah, blah, blah. So these algos suddenly go, oh, that means that the dollar euro should be a half pip higher than it is. So the algo will go bam, it'll do the calculations ultra fast, put the trade across in under 3-4 milliseconds, 5 milliseconds. And they will hit in general, it's the foreign exchange markets. They'll hit the liquidity providers, the banks, and they'll take 100 million, 200 million in a second, and not in a fraction of a second, and then a fraction of a second they are out again when the market's moved, and they've made half a pip. So the banks hate them because the banks are expected to add liquidity, so they're there all day long, adding their liquidity, being pretty fair about it, add their liquidity, and suddenly these guys just come in, these ultra-fast techies, and they're not adding liquidity, they're just taking liquidity, they're just taking money out of the market. So actually, most of the brokers, who the algos have to go through a broker, most of the brokers won't really let them. It's very difficult for the brokers because they make money out of it. They make money no matter who wins and who loses, of course, because they charge a little commission. But the banks will say, well, I don't want to see that trader again. And so from the broker's point of view, the liquidity is much more important than a client. So whilst the algo traders are, they're very good at what they do, it gets very difficult for them to actually do business because the brokers will just shut them down.